Welcome to the Real Estate Syndication Show. Whether you are a seasoned investor or building a new real estate business, this is the show for you. Whitney Sewell talks to top experts in the business. Our goal is to help you master real estate syndication. And now your host, Whitney Sewell.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today, our guest is Brett Swarts. Thanks for being on the show, Brett.
Whitney, thanks for having me.
Now, I'm honored to have you on the show. You have some skills that we need to know, right? You have a specialty here that I'm looking forward to getting into today. And but a little about Brett. He's the CEO of Capital Gains Tax Solutions, and every year equips hundreds of business professionals with the Deferred Sales Trust tool to help their high net worth clients solve capital gains tax deferred limitations. Experience includes numerous deferred sales trusts, Delaware statute trusts, 1031 exchanges, and $85 million in closed commercial real estate brokerage transactions. An active commercial real estate broker and investor himself with experience and holdings in multifamily, senior living, retail, medical office, and mixed-use properties. He's a licensed California real estate broker and holds Series 22 and 63 licenses. He formerly was an associate at the largest commercial real estate brokerage firm in the country. So, Brett, thank you again for your time being on the show today. Give the listeners a little more about who you are and exactly what we're going to talk about today.
Yeah, thanks. Thanks, Whitney. Yeah, so I live in Sacramento, California, five kids with my wife, Melanie. We've married 10 years. And we kind of grew up native California, originally from Mission, San Jose Bay Area, where I learned kind of the real estate world with my dad, building custom homes. But spent the majority of my time actually in Rockland, California, which is in Sacramento. Played sports in high school, played basketball in college, and learned about investment real estate in 2006. And kind of haven't looked back. It's been my passion and love for helping people create and preserve more wealth through passive and or active investment real estate holdings. So learned about a tax deferral strategy along the way. And now we want to empower business professionals like yourself and others to help people defer tax and do more deals.
Okay. So you are going to help us to defer tax. I mean, that sounds pretty good, right? That sounds pretty good.
Yeah.
So, get us started and what, as a syndicator in the syndication business, I guess get us started and some things we should be thinking about what this means for us.
Yeah. So most commercial real estate syndicators, they have partners and even themselves, they struggle with capital gains tax and depreciation recapture when they go to sell their high-end primary home, business, or commercial real estate. And we use a deferred sales trust, which is just an installment sale, creative installment sale, to give them tax deferral, liquidity, diversification. And the best thing is the ability to buy or invest into other commercial real estate deals at optimal timing so they can create and preserve more wealth. And as a commercial real estate syndicator, so that you can add massive amounts of value to your partners, and so that you can create and preserve more wealth and attract more capital. Well, a better way to put it is unlock the capital that is stuck in an illiquid asset. So to give you some more context here, according to the American Bankers Association, there's about $17 trillion that will pass from one generation to the next in the next 20 years. And this is known as the largest wealth transfer in the history of the planet. And this is by the baby boomer generation. And in fact, alone in America, there's about 77 million baby boomers, and every day about 10,000 of those turn 65. And what's happening with them is they feel really trapped. We call it the perfect storm, and they're trapped because they want to get out of the toilets, the trash, and the liability. And they want to be able to maybe retire and from the active management of commercial real estate and be more passive, right? With a syndicator who perhaps is a little bit younger and is maybe in a different geographical location and has some value-add forced appreciation opportunities versus their one particular town or city that they're in. The next thing has to do with just interest rates that are hovering near 40-year lows, and real estate and businesses appreciating a great deal. And we call this the perfect storm of what do you do and how do you help that group to diversify and get liquid and then be able to invest in deals that you have lined up.
Okay. Wow. Yeah. 77 million baby boomers. And you said 1.5 million turning 65 every day.
10,000 turning 65 every day. Yeah.
Wow. Okay. Yeah. 10,000. Okay. And then, interest rates at 40-year lows. And so, get us started as far as like what this means for, the syndicator, what we should be doing or thinking about, to understand how to use a vehicle like this.
Yes. So most of you, your listeners, and I know you know about the 1031 exchange, right? Which is a tax deferral strategy for investment real estate, for like-kind real estate. And you know the value of that because essentially you can defer the tax and roll it into a deal and keep that growing your wealth, right? Versus paying the tax, which is about 30 to 50%. And that's usually what we're working against. 30 to 50% of every deal that's sold is going to be hit with capital gains tax, state, federal, Obamacare, and then plus depreciation recapture. And instead of paying that, you do a 1031 exchange, right? But the challenge with most syndicators we work with, our operators, is a lot of them don't allow exchanges into their deals unless it's a certain deal size. And also on the flip side, when they go to sell, everyone's just paying their tax. So enter the Deferred Sales Trust. The intent is to defer the tax. The problem is there's not a clean or concise way to make it happen with the 1031, whereas the Deferred Sales Trust is very flexible. Each partner can go their separate ways. It also works and have their own Deferred Sales Trust, or they can just pay their tax or do a mixture of both. And then invest it into your deal. The next thing has to do with timing. In a traditional 1031 exchange, you have to do something within 180 days, meaning you sell and buy something within 180 days and identify within 45. So the intent, again, is to find a deal, but the problem is, especially if it's a highly appreciated marketplace, especially in the properties they're selling, it's difficult to find a deal within a certain period of time. Whereas the Deferred Sales Trust is a solution for this in that you can put the funds in the trust and you can buy whenever you want to, meaning optimal timing, right? Tomorrow, day 181, 5 years from now. Part of what happened in the 08 run-up, Whitney, and I witnessed this firsthand, especially in Sacramento, is one of the hardest hit cities in America, was people were selling real estate 04, 05, 06, 07, and they were 1031 exchanging into bigger and bigger properties. And the challenge is they were overpaying a lot of times because of the tax. And so we say, no, there's a better way to do it. You can actually get out of debt. And also that's what the 1031 oftentimes it forces you to do, to stay in debt or take on more debt because of the equal greater value rule. And instead put it all into the Deferred Sales Trust. And now you're liquid, you're diversified, and then you can go into multiple syndication deals right across the US, smaller amounts. So it's just a more flexible way to defer tax. And then again, for the syndicator to unlock that capital for folks that want to sell that business. We've done thousands of these transactions with veterinarians, dentists, doctors, tech companies, apartment complexes, self-storage, and they want to attract that high net worth. But a lot of those clients, they feel trapped in those properties and they don't want to do another 1031 if it's investment property, but they love the Deferred Sales Trust to unlock that capital so they can deploy it into your deal tomorrow.
Okay. So can you walk me through an example, like when would something like this apply? How do we get it started? Where at in the process of the property and selling and buying?
Mm-hmm. Yeah, let's walk through an example. So I just did a recent deal in Sacramento. It's a $1.8 million sale for a gentleman named Peter. He was about turning 70. He's out of Marin, California. He's driving to South Sacramento to manage 18 units. It's one of those deals where it's kind of hard to hire management because it's not that big. And if you do, it takes a lot of the profits away. So he's doing a lot of himself. And he's always been a hands-on guy too. So he's done multiple 1031s over the years. So he has not only debt on the property, but he also has a big capital gains tax of $500,000. And he told me, Brett, look, I didn't want to trade 18 problems for 36 problems. I made my wealth. I don't need any more of these headaches. I mean, he's banging on doors, trying to collect rents, making evictions, and he's just going, I want to be done, right? But I also don't want any more debt, and I don't want to overpay. And so enter the Deferred Sales Trust. He sold it, moved all the funds into the Deferred Sales Trust, paid off all of his debt, and deferred $500,000 in capital gains tax. And here's the biggest reason why. He said, Brett, I want to buy or partner with people who are who are operators at anytime, tomorrow, or when the deal comes up. He thinks the market's going to shift in another 1 or 2 or 3 years, and that's when he's going to be poised to strike. In the meantime, he's invested in stocks, bonds, mutual funds, diversified, liquid, conservative stuff, nothing that's too much stocks, and he's just keeping his powder dry. So it comes up in those scenarios, right? For the gentleman who's older, who wants to diversify, wants to retire. For the syndicator, it comes up because again, we're looking for ways to attract and unlock wealth to invest in our deals. So the way we do that is we provide the solution for folks, right? The solution to be able to do that. So again, if it's a business, if it's artwork, if it's a collectible, the deferred sales trust works for all of those. A 1031 is very specific. It only works for investment property. So that's where it falls short. The other part is for the people you're actually buying from. Okay, so now I want you to put on the actual syndicator. I'm looking for to find the deal, and who's the ideal person to buy from? Well, it's the mom and pop who's kept the rents low, who's been very nice to the tenants, who's owned it for 20, 30, 40 years, who's fully depreciated, who doesn't want to do another 1031. They don't need any more money. They get calls all the time with, hey, why don't you do a 1031? They're going, no, I've done that for 40 years or 30 years. So you want to buy it from those folks where there's a value add for depreciation. So enter the deferred sales trust. When you call them and say, hey, look, Mr. Owner, I know you don't want to do a 1031. There's actually a different way for you. It's called a deferred sales trust. You've just solved their problem. They're more likely to sell to you versus anybody else. They're more likely to sell off market to you versus anybody else. They're more likely to take a lower price. Why? Because they're going to save 30 to 50% on their sale, and they're going to be liquid, they're going to be diversified, and they're not going to have to do the active real estate. So I'll pause there because I know I just said a lot, and that's probably maybe some questions you have.
Yeah. So I was thinking about, so go back to the first example. So the guy that sold the 1.8 million, so he sells that, he puts all that in a deferred sales trust. So now he can invest it however he wants, right? So
yeah, there's only two exceptions. You can't put it into a primary home, and you can't go overseas, but it can go into investment real estate with up to 80% of the funds. The remaining 20% will stay in stocks, bonds, mutual funds. Okay. But it can also go into a business startup as long as there's business purpose and investment to be made within the U.S. Yes.
But he did have to pay some capital gains, or he did not?
No, 100% deferred. Yeah, he put all the proceeds in there, so he's 100% deferred.
So when will he pay taxes? Well,
good question, Whitney. When would you like to pay taxes? So most of our clients like to pay the taxes second day to never, meaning they're just going to live off the interest, or they're going to keep 1031ing and just keep doing that. So the moment he takes boot, or the moment he receives actual receipt of the cash, which is when it's triggered, which is how this works, which, by the way, it's how a 1031 works. So let's walk through how this kind of works, Whitney. All right. So you ready? You're going to be the seller, and I'm approaching you. Okay. So Whitney, you're selling a $10 million deal. It has a zero basis. You have no debt. And if you were to sell today, you would owe, let's say, $4 million in tax. Okay. So you definitely want to do a tax deferral strategy. Okay. Because those numbers are pretty brutal if you pay the tax. So I approach you as just a regular person off the street, and I say, I'm going to buy your apartment complex, Whitney. May I give you a $2 million down payment? Would you please carry a note for $8 million? Would you do a seller carryback? And let's just say you say yes. So in that scenario, Whitney, if I give you $2 million down, how much actual receipt did you receive?
And that's yes.
Right. So you're going to owe tax on that too, because that's what it triggered. But
right.
That other $8 million is what's called a seller carryback. It's in a deferral state. You follow?
I am.
Okay. Now, what if I said I'll give you a zero down payment, Whitney? If I give you a zero down payment today and you carried a note for $10 million, hypothetically, or you wouldn't do that because in a real world, I have no skin in the game, but let's just say hypothetically you would. How much tax would you owe if I gave you a zero down payment today?
None.
Zero, right? Because you haven't received anything, and the other 10 million is in a deferral state. Now that income's the interest is gonna happen. I'm gonna pay you interest, and you're gonna pay ordinary income on that interest, right? So that's how a deferred sales trust works. Here's the difference. We have this $10 million buyer lined up, and we have Whitney ready to sell, and they're about to do the transaction. But what happens is the trust jumps in right between, and it actually buys your position for $10 million in exchange for an installment note. It gives you a note. It gives you a zero down payment in exchange for the property, and immediately turns around in the same escrow and sells it to that buyer. And that buyer puts the $10 million into the trust. So if the trust bought it for $10 million and sold it for $10 million, how much gain does the trust have?
Zero.
You got it, right? And if Whitney, again, if you took a zero down payment and exchanged for the note for 10, you're in a deferral state. So how much do you owe today?
Zero.
You got it. Okay. So the buyer takes title, he's gone. So that's how it all works, right? That's why it works. It's a 1920s tax law, goes back 90 plus years. We're just creative on how we apply the law. And that's exactly what the IRS said too. This is how we know it's legal. We have thousands of business professionals across the U.S. But all that being said, what it does now for you as a syndicator or as the owner is it takes you out of those timelines of that 1031. Because the tax law for 1031 is IRC 1031. Whereas us, we're IRC 453. So these are two tax deferral strategies, but they have different rules. And these rules for the 453 are much more flexible than the 1031, which means no equal or greater value, no short time period, no replacing of any debt of any kind, multiple product types, multiple investment vehicles, and I can go in and out of the trust, all tax deferred for as long as I want. And the best one I think for you guys has to do with depreciation. So in a 1031 exchange, the depreciation schedule travels, right? Meaning if you take any accelerated depreciation on deals or any depreciation for that matter, and you sell and do a 1031 exchange, that depreciation schedule goes into the next deal, meaning you need to buy a bigger property to offset it. So let's say it was a $10 million deal again, you fully depreciated it out. If you were to sell today and buy an exact $10 million deal, there's no new depreciation. It's already zero. If you buy a $25 million deal, well, now you've got an extra $15 million in depreciation, okay? But that might take on a lot of debt and a lot of risk. So some people are like, I don't know if I want to do that. Well, enter the Deferred Sales Trust. We could sell that same $10 million, put it into the trust, use $8 million to go purchase, let's say, a $25 million deal. Now there's a brand new $25 million deal amount of depreciation. It's a brand new schedule because I didn't do a 1031. I partnered with my trust to purchase this. And that's very powerful. So now you can do accelerated depreciation to offset the income everywhere. So I just said a lot there. I'm going to pause because your brain might have a few questions there.
Yeah. And I'm not even sure where to start at this point. I'm going to have to go back and listen to part of that myself. It's good. That's good stuff though. And I was thinking through though, like how I would explain that to that seller or explain that to somebody, or, and they're like, Whitney, I don't have a clue what you just said, or, I've never heard of this thing before.
Brett, let's watch a webinar. Let's get your CPA on the line. And this is what we do every day. We're just educating and walking people through all of this, and we're holding their hand. And this is the other way I like to put it, Whitney. We're just like the nurse, okay? So when someone comes to us with a challenge, you're like, hey, it looks like you got a challenge there with capital gains tax. You may want to talk to the brain surgeons. Who are the brain surgeons? So the tax attorneys and CPAs who actually do the surgery, do the Deferred Sales Trust surgery. So I'm still just like a nurse too. And so when they come to you and they say, I have this, I have that, well, go talk to your CPA, your tax attorney, and see if surgery is good for you, right? And make sure we get their blessing before moving forward. And so that's what we're about. We want to bring, we have CPAs, national law firms, financial advisors, commercial real estate brokers, all across America who have used this structure, who have vetted it, and who can help other people do this. And my role, by the way, is the trustee. So I'm actually the third-party trustee, and I educate. I'm kind of like the offensive coordinator in this whole transaction, make sure it all goes well, which leads into the next question, which is typically this: well, how do I know my funds are protected? Okay. And what happens if I get audited, and all these different things? Okay. So the funds only ever move with your signature, Whitney. You have what's called DACA account protection, meaning it's direct access control agreement. It's like an escrow for your funds with the financial advisor, right? That you can bring in others that you like and want to use, or you can use one of our trusted advisors. I never manage the funds. They're never my personal accounts, so I can never take them. So those are always safe all the time. They only move with your signature. The other thing is the IRS audit. So we survived 14 of those. And by the way, if anyone ever comes to you with a new tax deferral strategy that seems like it's too good to be true, or seems like it has a lot of promises, you need to ask them a number of questions. You should ask them, how many IRS audits have you survived? That should really be the first question. And the answer is 14 for us. And the next question is, how long have you been doing it? 23 years. How many have you closed? Thousands of transactions. If those three questions aren't answered in a way that have a track record, proven track record, and also the IRS audits, then you probably don't want to touch it. But we're batting 1,000, not one single issue with any of the trusts, not one single issue with the IRS. And so, yeah, that's why it's legal. We also, the tax attorneys who set it up, they provide audit defense to help you there too, if you ever were audited as a part of the fees. But more than that, we want you to get to know us, digest this as best you can. But it's like riding a bike, Whitney. The first time you ride it, it's going to be a little bit awkward. The first time you did a 1031 exchange 20 years ago or 10 years ago, it was a little bit, shaky. But eventually you start to get comfortable as you rode the bike. And that's what we want to provide for you.
Nice. So, I was thinking about the individual that you said they can invest 80% in wherever they want. 20% is going to be stocks and bonds, I think you said. And so how long do they have to invest the 80%? Or is it just whenever?
Flexible, right? So let me tell you a story. In 2006, a gentleman, he's one of the largest deferred sales trust clients. He sold a big building in Minnesota, and he saw the writing on the wall. He didn't do a 1031. He did a deferred sales trust. And 5 years later, he bought that property back at a discount through his deferred sales trust at 60 cents on the dollar out of foreclosure. Okay, so he sold at the peak. He waited 5 years. The same property he sold went to foreclosure. He bought it at 60 cents on the dollar from what he sold for. All tax deferred. And he's really happy, right? So what's your optimal time, Whitney? Did you find a deal tomorrow? Is it day 181? Or do you want to get your powder dry and just sit on the sidelines for a couple of years? Right? Do you want to wait for after the election? It's your money. How do you want to receive it? Either you can pay the tax, or perhaps how do you want to invest it, right? So that's really, really flexible when it comes to those things.
And what's happening with the money while it's in there? I mean, I know you mentioned it's not in your account, and things like that.
Based upon the Yeah, hopefully it's earning interest based upon the investments that it's in. So, by the way, most of our notes earn 8% depending on the risk tolerance of the individual over any 10-year period of time, and netting after fees about 6.5%, okay, on the cash flow. So in your scenario, if it was 10 million, right, it's earning about 8. Instead of earning it on 6 million, it's earning on the full 10. And now you're paying incremental fees along the way to the financial advisor, to me, the trustee, and you're living off that cash flow. At the end of 10 years, you can renew for another 10 years, and then renew for another 10 years, and just keep renewing it. And then it can pass into your kids, and they can do the same thing. And then you can use it, this is the best part, you can use it to fund charitable organizations or fund your family legacy for whatever you want. It becomes a part of your estate, right, that passes. So your kids can just live off the interest and continue to do this as well. They inherit your position. So it's flexible. And then also too, if you want to cash out all or a portion of it, you can, and you can pay the tax in that given year for that amount. Some folks want to wait till they move to a new tax-friendly state like in Nevada or Florida or wherever else, and pause the income. So I'm going to pause. I'm going to sell my $10 million deal. I don't want any income right now. I'm going to wait, move, establish residency like in Florida, Nevada, then turn it on. So in the meantime, it's just compounding, right? It's building up. So the answer is it's your money. How would you like to receive it? And what are ways we can invest it to make it have a nice return?
So you briefly mentioned it a minute ago, but I wanted to ask about, what it costs us. Are there fees? How does that work?
Great question. Yeah. What are the fees? Yeah. So the fees, there's 3 sets of fees. The first set is to the tax attorneys, and that's about 1.5% on the first million. And that's a one-time fee. Okay. And then 1.25% on anything above. So let's just say it was a $3 million deal. Be 1.5 on that first million, the 2 million that's left over, be 1.25. And that includes the legal and tax structure and also audit defense for the life of the trust. The second fee is to Capital Gains Tax Solutions as the trustee fee. That's my company. And we charge 50 basis points as long as that's a half of 1%, as long as it's 100% with the financial advisor. If you go out and you want to do the real estate deal, then it jumps to 100 basis points or 1%. Now, the financial advisor, it just depends on how and where the funds are invested, but somewhere between 50 and 100 basis points. Remember when I said most of our notes earn 8, after fees, they net about 6.5? That's how we came to that equation. However, over that 10-year period of time, the expectation and the goal is to return 8 net of all fees. But when you're out buying other deals by partnering with your trust, and here's the power of this, you're setting up a partnership between you and your deferred sales trust. And with that, it's typically around an 80-20 split, meaning this silent partner put up all of the cash for the down payment, but you're the sweat equity owner who's operating the deal. So although you personally, Whitney, put $0 into the deal, your trust put up 100% of the down payment, you have 80% ownership. The trust has 20%. This is also how we get a new depreciation schedule. So what does that mean? Well, that means on this deal over here, the 80-20 split after the preferred return is paid back to the trust, which is just going to turn around and pay you too, but the remaining 80% goes to you, right? So, and you put no money into the deal, right? So, I mean, it's the trust put the money in the deal, but you outside of that didn't put any money in the deal. So we call it the go fund yourself, right? So instead of having to go to a bank or go to a venture capitalist for a business venture or whatever, why don't you use your own funds in your deferred sales trust to help partner you with the deal? So hopefully that makes some sense.
It does. And how long should this take? You know, if or let's say I have an investor that says, you know, I'd really love to, 1031 into a deal, and they're wondering about the timing and wondering, how long that would take to have these funds available. And I tell them about what you're doing. How long does that take?
So to set it up, we've done deals in a week, right? But
okay.
Ideally we're 30 days before closing. We do need to do it before they remove all contingencies. For investment, for a business or for a primary home or artwork and collectibles, we need to make sure we have language that's inside of the purchase and sale agreement or an addendum. Okay. If it's an investment property, we can save a failed 1031 exchange, day 46 or day 181. However, you need to work with the QI company that's going to allow both options. We have those available for you right now. Or use your own QI company, but make sure we put the language inside of that document first, okay? So just get to us early, okay? Earlier the better, so you can digest this, you can vet us, get to know us, meet us, all of those good things that you should be doing, you need to be doing. Now, once it's in the trust, how quickly can I access the cash to go buy that deal? We call that trade plus 3. It's 4 business days, okay? So you're in stocks, bonds, mutual funds for a year, everything falls apart on some real estate deal, opportunity pops up, great. And you say, okay, I'm ready to buy this deal. Great. It looks like a good deal. Let's do the deal. Sell, move the funds into a brand new LLC, which you're the managing member of, and partnering with the trust and you go buy that deal. So trade plus 3 for the funds.
Nice. So if I have a property I'm going to sell, I need to be talking to you all, at least a month ahead of time, right? To make sure we got all the language and all that.
Yes.
In the contracts, all the contingencies, and depending on what we're selling, and then really just a few days after.
You got it. Exactly. And remember too, we don't charge, I don't know if I mentioned it, but we don't charge anything unless and if you close on the deal. So we will literally walk you through it, educate you, your advisors, get everything set up, ready to go. And for some reason the deal doesn't close, no problem. For some reason you decide to do a 1031 or something, no problem. We don't want to pressure anyone to do this. We just say, hey, here's the availability. We just need to be early and proactive and give you the opportunity to do it. And you decide if and when you want to do it.
Okay. We better get a few last questions in before we run out of time, Brett. But what's the hardest part of this process?
It's just getting over the fact that it's not your traditional 1031. So real estate is like a religion, okay? It's like a religion in that there's certain doctrines, especially commercial real estate, where there's the old school of thought that one of the doctrines is the 1031 exchange. And when somebody, imagine a pastor brings in a new doctrine of this installment sale, which by the way has been around, you guys know the installment sale, but you haven't been using it. It's kind of like a 1031, there's a reverse exchange. Some people don't know about that, but they know about a 1031. So it's just a nuance on what's always been there. But they just seem like it's too good to be true. How have I not heard about this? How's my CPA not told me about it, right? And so just getting over the fact that some people don't know because they haven't been educated. And another analogy would be like a doctor. You go to your primary physician, and your primary physician has taken care of you for 20 years, like the CPAs have taken care of a lot of people. But your primary physician, if you have a tumor, he's not going to do the surgery. If you have an ACL reconstruction, he's not going to do the surgery. So who's done the surgery? So sometimes the physician will say, oh, I don't know about that. I've never heard of it. I wouldn't recommend it. And the problem is they just don't know. And they have nothing to gain by saying, yeah, go for it, right? But the problem is you have a brain tumor and it's a capital gains tax thing and you're about to pay it and you need to have a solution for that. So you want to go to somebody who's been proven, who's done 2,000, 3,000 surgeries. Not one patient has died. Not one IRS audit has been a negative. It's batting 1,000, right? So you go at a certain point, you say, yep, I'm going to trust these guys because of their track record. Also, talk to our clients. Like we want to put you in touch. If you're really serious and you're going down the road with us, we'll give you the phone and number and you call and talk to the happy clients that have used it. So we've blazed the trail. We're not coming out with something new and saying, hey, Whitney, try this out, see if it works. No. We've already been through the scrutiny. We've already been through the audits. We've already blazed the trail. You just have to take that step of, okay, I might need somebody beyond my CPA who's just my general practitioner. I may need that brain surgeon.
That's a great analogy. I like that a lot. And but unfortunately, we're out of time. But before we go, tell the listeners how you like to give back.
Yeah, so my number one way to give back is a ministry called Agape International. It's a nonprofit, and they're based out of Cambodia. And what they do is they help free young children from child sex slavery. And so, practically speaking, as a part of Bayside Church that I'm a part of, and others that fund the ministry, is they have these SWAT teams, and literally guys with guns and the full SWAT, and they go into the darkest places and they rescue these girls that are trapped. And then they bring them into a school, and they educate them, and they feed them, and they take care of them, and they restore them so that they no longer have to be in such a dark place. So that's our passion. That's where our heart's at, and our goal is to help people to get out of their illiquid assets, get into passive cash flowing assets, so that they can fund causes like that or other ones that they really believe in and want to support. So thanks for asking, and that's yes, it's called Agape International.
That's awesome. I love that. I love what they're doing. That sounds just incredible and a great cause. Yeah, thanks for sharing that a lot. But very importantly, tell the listeners how they can get in touch with you.
Yeah, so capitalgainstaxsolutions.com. You can find me on LinkedIn, Facebook, YouTube, Bigger Pockets. Reach out to us. I have a free webinar. If you email me, I'll send you a webinar that I recently did with a multifamily real estate attorney and all of his students. And so it's an interactive visual presentation that you can see. You can pause it, rewind it, make sure you send it to your trusted advisors, have them vet it. And then after that, if you really have something, you can do a Deferred Sales Trust calculator. We have that link too, where you can answer 12 questions. It's going to give you a side-by-side comparison. And then we can engage and talk with the CPA tax attorney if you have a live deal. So it's a process, but just get educated, reach out to us, and we're here to help.
Very nice. Thank you so much, Brett.
Thank you for listening to the Real Estate Syndication Show, brought to you by Life Bridge Capital. Life Bridge Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. Life Bridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.